Hi, I'm Michael Monahan, partner and portfolio manager at Founder ETFs. We're in beautiful Boston Common today with Bob Elwood, a founder of practice law firm and importantly, the authority on 351 exchanges. Bob, could you tell us a little bit about 351 exchange and why an investor might want to use one?
Sure. A 351 exchange at its simplest is the transfer of a group of securities from typically a separately managed account to the ETF. It's intended to be entirely tax-free. And you might think to yourself, well, so what? We've taken it from one pocket and put it in another pocket in the form of the ETF. The nice thing about a 351 is once it's within the 351, you can rebalance your portfolio, generally speaking, in a tax-free manner. So, for example, let's say you were clever enough to have bought Berkshire Hathaway 25 years ago, and now your Berkshire Hathaway shares are worth vastly more than they used to be. Um, you might nonetheless be worried that Warren Buffett is getting older, and maybe Berkshire Hathaway isn't going to outperform the market the way that it has. By depositing the Berkshire Hathaway shares into the ETF then has the opportunity to essentially rebalance, getting rid of some of the Berkshire Hathaway shares and buying, let's say, NVIDIA or some other high-flying stock instead.
Wow, it seems like a really good tool for investors who've got a highly concentrated position, something they've frankly been successful with and even happy with, but over time they want to diversify and maybe have new opportunities. So, can we get into some of the technical aspects? Like, can I just bring one stock or do I have to bring a portfolio of stocks? Could you walk me through maybe some of the mechanics of what the portfolio should look like?
Sure. There are two key requirements. One is that the largest name has to be less than 25% of the total portfolio. So somebody that only had, let's say, had worked at Facebook, they can't just put in Facebook shares.
Okay.
And then the top 5 positions have to be less than 50% of the portfolio. And those are hard and fast rules. To give you just a little bit of a flavor, we worked with an investment manager who had many of its clients in Apple. A week before, everybody was down to make sure that the Apple was set like less than 24%, only to discover that week Apple went through the roof. So at the closing, we had to basically pull back a lot of Apple trades just to make sure that the total Apple exposure was less than 25%.
That's really helpful to know. And one thing that I was researching, and I just want to confirm with you that if an investor brings, say, another ETF, the IRS looks through that to the underlying holdings. So could I bring, say, 25% Apple and the other 75%, say, SPYs or Qs, and that way it would be 25% Apple and 75% other things through the look through to the ETF. Am I thinking about that correctly?
Yes, but there's actually a real trap for the unwary here. Generally speaking, the look-through for ETFs is good news because, for example, with SPY, you've got 500 positions represented by the SPY position. But in your situation where you had 25% Apple and 75% SPY, Apple represents roughly 7% of the SPY. So if you multiply 7% times your 75% position in SPY, suddenly you've got roughly another 5% of Apple, and suddenly you're at 30 or 32%.
Okay. So within reason, but you got to keep in mind that if one of your holdings is showing up inside the ETF, it may overweight what you're bringing. But in general, the IRS looks through and sees ETF as a diversified basket rather than one
Correct.
security.
And 90% of the time, it's great news for you.
Awesome. And is this something new or is this something that's been around a while? Could you maybe frame how often has it been done, or at least in your experience? And maybe where did this law come from? Why is it sitting around on the books and why are we able to take advantage of it?
So Section 351, believe it or not, has been in the Internal Revenue Code for almost 100 years. It's generally used for operating companies. The first one I did was probably 10 or 15 years ago, but until recently, it wasn't all that attractive because up until about 5 years ago, when the SEC changed its rule as to which types of ETFs can be actively managed, the thought was, why go from an actively managed SMA to an index-based ETF? But now you can go from an actively managed SMA to a actively managed ETF.
Okay, so that answers the why now question. Is that you had a combination of an existing tax law that sat on the books, and you had a change in the regulatory environment where now it makes sense to have these actively managed ETFs and to seed the actively managed ETF. It makes sense to put maybe some of these pre-existing baskets in and allow the investor to own a basket of names that they find perhaps better or more helpful to them.
Exactly. And we've done a ton of these. And the nice thing from the perspective, if I'm an investor, I want to make sure that there's no meaningful risks here. And the nice thing is you've got a statute. There isn't some like shades of gray thing. You've got a statute and regulations that more or less tell you what you need to do to accomplish that. And if you do that, you should get the expected tax result, which is no tax on the transfer. And I don't know, like we've done something like 100 of these. So it's been a process where occasionally we hit bumps in the road, but we figure it out. In some cases, we haven't been able to find a solution, but at least we can tell you about that way before any kind of problems occur. And in the case of almost all the other bumps in the road, we figured out solutions for them.
Awesome. So we kind of have you to give both us as the fund advisor and our clients that they get the great counsel being able to talk to you to make sure that this is all structured in the best way possible.
Absolutely. We're all in the trust business, and need to make sure that the clients are comfortable that they're going to get the results that they expect, both at an economic level, a tax level, and frankly, they just want to sleep well at night.
Awesome. That's super helpful. And we feel fortunate to get to work with you. I think something else that we should probably note is that there's really no cost to the end investor. There's no cost to bring these securities in, put them into the portfolio. Really, the only long-term cost to the investor is the small basis points that the ETF fee charges on an assets under management basis.
Correct.
Bob, what do the major brokers think about this, and which of the brokers have you found to be most helpful in affecting one of these transactions?
So, generally speaking, it's been a process of education. When we first started doing these, a lot of these, say 4 or 5 years ago, we had a lot of process in which we had to go to the Schwabs, the State Streets, you name it, to explain what was going on. We've generally had a really good success rate of explaining what's going on. And generally speaking, just about all the major brokers are comfortable with this. But you name it, Fidelity, State Street, all the other big pro players, they've gotten to be comfortable with it. And we want to make sure that they work well with everybody else.
That's really great news. It sort of makes it available to almost any investor.
Correct.
Bob, what types of securities are eligible?
Um, Generally speaking, just about any stock or bond or thing that you would think of within the definition of security. There are a handful of exceptions. Generally speaking, mutual fund shares won't work because they're not traded on an exchange. There are certain other things in which, um, various types of derivatives, options, swaps, other kind of things like that generally won't work. But if you think about things that are traded on an exchange, you can generally make those work.
And what types of entities can participate? Individuals, LLCs, C corps? What entities can take advantage of this?
So individuals work. Trust accounts generally work, but we kick the tires to make sure we know who the beneficiary and other economic players are with the trust. LLCs work, but again, we kick the tires to make sure we understand who's sitting behind an LLC or a partnership. For various technical reasons, C corps don't work. It is possible to do one, but the headaches are sort of outweigh the benefits of doing that. But just about any other type of entity will work.
That's really fantastic.
So, Michael, let's talk about deadlines.
Yeah. So in order to participate, you've got to put your securities in and deliver them to us 7 days before the closing.
And what's the deadline specifically in terms of a date?
You'll need to deliver your securities by November 30th to participate in the 351 exchange.
So, Michael, where can people find out more about this?
Go to founder351.com, and we've got all the information laid out for you in an easy to read, easy to consume format, so you can take advantage of putting your appreciated securities into the new Founder ETF.
Beautiful.